So the FOMC did not change rates. That was what we expected. Economic data has generally been good, as we also expected, but the market's a little bit weaker. We're going to talk about some of these things and take your questions today on Open Interest. Hello, everybody, and welcome. Welcome to Open Mic. I'm Mike Coe. So we have gotten some of the economic releases that we talked about on Monday. Why don't we go over some of those right now? So I'm going to share my screen so we can take a look at some of the things that came out since we did that Open Mic. So I'm going to ignore anything that came out on the 28th. We're only going to look at stuff that came out yesterday and today. So let's just go over some of those. And determine whether or not we think these things are really important or notable. Let's just start with the wholesale inventories. So I'm just going to highlight on my screen. I'm going to try to use my annotation tool as much as I can. Remember that when it comes to inventories, if inventories go up, that could be an indication that consumption has dropped or spending has dropped. So in general, we would prefer that those numbers are pretty much flat, that we don't see a big inventory build. For individual retailers, this is particularly important. So if you see a big, this was one of the problems some of you may remember that Target faced. They had some issues with inventory. And if we go back several years and we think about how Nordstrom's, for example, was doing relative to some of their retail competitors, this was something that they did very effectively. Their inventory management was exceptionally good. So we had a little bit of a build there, something just worth paying attention to. So I'm going to get rid of that. And then but if we then take a look at the next potential category that we have here, which is this overall month-over-month retail inventories number. This is not a widely observed number, and it's not something we discussed, but I wanted to just point out that if you're wondering why the wholesale inventories number didn't seem to have a huge impact, maybe this is one of those things that we can potentially take a look at, right? So that inventory number, not too bad. Meanwhile, as we take one of the other things that we had been paying attention to was sentiment. So we were interested in, these are the things that we broadly try to pay attention to: inflation, economic growth, business and consumer sentiment, and labor data are kind of the big four categories if we're going to make generalizations about the stuff that's coming out. And sometimes that information is going to come from the private sector. Sometimes it's going to come specifically from the government. Other times it's an interpretation of some policy shifts, and there's an important policy thing that came up, which we're also going to get to. But we can see that actually when we look at the Conference Board consumer confidence numbers, which was something else that we had said we were going to be paying attention to, you can see this is broadly followed. You can see that over here. This number actually came out better than expected. So hopefully you all can see that. All right. So this may just skip out on me for 1 second. I'm going to hit a button over here because I have to escape from my annotation tool so I can scroll down. Not great on the MBA mortgage applications front. That's this figure right here. Look, the housing situation it just continues to remain a little bit difficult. I heard somebody commenting today on an unnamed business news channel, which obviously would not be CNBC, talking about whether or not people should be concerned about the fact that the FOMC left rates unchanged and its implications for mortgage rates. Don't know where they were getting that, which is maybe one of the reasons I don't want to sit there and point the finger at them. It is not the Fed funds upper bound target rate that sets mortgage rates. Okay, so home affordability, which continues to be a problem, is a function principally of median home prices relative to median incomes, plus if we're going to use any rate to think about, it should probably be something like the bank rate 30-year fixed average mortgage rate. So sort of what a prime home buyer would pay on a 30-year fixed. Those are the real issues. And of course, if other input costs for households or expenses, I should say, are high, due to things like inflation, that's going to compress their ability to set aside money for a down payment. Plus, the monthly payment of higher mortgage payment is going to be a problem. So I would say that we're not going to see anything that immediately fixes this situation that I can think of. But that, I think, is obviously something to pay some attention to. Now here, this was actually a better than expected number. So we got the GDP annualized quarter on quarter. This came out at 3%. So economic growth actually tracking better than the survey number. This is definitely a positive. And it's even more important when we think about it in the context of concerns about whether or not tariffs were really going to end up being a drag on things. So not bad there. Personal consumption down just a little bit, but here too, this price index, we have conflicting data. So the GDP price index, 2%, and then the core PCE price index. This one came in a little higher than the survey number, so that's obviously not great, but better than the prior period by a considerable margin. We just talked about the home prices, and then of course, the data that we got today from the FOMC, the rate decision, unchanged. Not a big surprise there. However, what is going on underneath the hood of this? So remember, our expectation was that the FOMC would not change the target rates. The real question was, would the commentary coming out of that be dovish or hawkish? So what you're looking at right now is the probability of a rate cut at the next meeting. And you can basically see what happened here. So 2 o'clock is when we got the FOMC data. And what we can see here is that this, this number changed quite precipitously. So there is, I think, the market's interpretation is that there is a better chance now that rates remain unchanged, FOMC rates, at the next meeting than I think the common view was going into it, right? I think that's kind of the way we can read this. What's interesting also to me, though, is that if we take a look at the VIX futures curve, and this is the live one. So let's just compare this to where we were a week ago. Very steep still. But, if we take a look at where we are live relative to where we were a week ago, it's pretty much lower across the curve. Everything except spot VIX, which is only nominally higher. This was actually a lot higher earlier. That's because right after the meeting, we actually saw the VIX tick up to, it was actually north of 17 at one point. But broadly, it seems like that concern at the back end has come in just a little bit. So I would say that in general, the data that we're getting is positive, right? So, economic growth is as good or better than expected, generally. Inflation has generally been giving us pretty good numbers. The corporate earnings slew, we can get an update on this because we've had more earnings since the last time. So what I'm going to do here is we're not going to look at the current season. I'm actually just going to look at a sort of a custom period from July 1st to present. That's all securities. I should really probably be filtering this a little bit more. That's now taking a little bit of time to update. Come on. Why won't you do what I ask? There you go. All right. So this gives us a sense of how we're doing relative to expectations. So in general, we have seen revenue beats by about 2.2% for those companies that have reported. Here we're looking at about 3,000 companies anticipated to report over this period of time. Earnings surprises have a little over 7%. But arguably just as important, and to me maybe even more important, is how good are things generally? Let's forget about what people's expectations were, but how good are things? Are companies actually growing? Are they growing at a good rate? Are earnings growing? Are they growing at a good rate? Because let's just say that we beat numbers, but everybody had really grim numbers. That's not really helping us. And this is, I think, where we're seeing something that is a little bit more important and more remarkable. Year on year, so comparing from July 1st to the present day, so the first 30 days of July of 2025, comparing that to the first 30 days of July of 2024, these are the year-on-year numbers that we're getting. 6% year-on-year of those companies that have reported. So we're looking at about a third of the companies that will be reporting, that have reported so far. 6% year-on-year revenue growth, 10.5% year-on-year earnings growth. So far so good. I think these are pretty solid numbers. So we're pretty happy about this. So I wanted to sort of get started with all of that, and then we can get on to taking some of your questions. And it looks like we have a couple good ones. So Jim Howard, Mike, you regularly look at revenue growth, forward price to earnings, implied volatility. How about short interest? Do you look at that each time? Is there a short interest percentage threshold that affects your decisions? Either way, thanks. Do I look at short interest every time? No. But part of that is because in many cases we're looking at companies where I'm pretty well aware of what the short interest picture is to begin with, right? So if I'm looking at companies that I have not looked at, especially smaller cap companies, I will look at the short interest and see whether there are some potential implications there. Examples of stocks that have high short interest that have been getting a lot of attention from traders recently would be something like Kohl's stores, right? Oops, where is that going and why isn't it working? Here we are. So we saw a lot of options activity in here. And this was, a lot of people were asking, are we going to be getting back into one of these sort of meme stock sort of frenzies like we had before, another AMC, another GameStop situation like this? Now, I want to make a quick point here, which is that just because a company has a relatively large short interest, that does not necessarily mean that it is vulnerable to something like a short squeeze. So obviously you will see very high short interest in those names that are vulnerable. But it doesn't necessarily mean if a company has 20% of the float short, that doesn't necessarily mean that it's vulnerable to a short squeeze. There is something else, which is that holders of shares can, in theory, make it that the shares that they hold are not available to borrow. So if shares are held in street name, which is how when you buy and sell stocks, they're generally in street name. What does street name mean for those of you who aren't aware? If I have an account at Interactive Brokers and I bought Kohl's stores, Interactive Brokers makes a journal entry that reflects my interest in Kohl's stores, and I'm known as the shareholder as far as Interactive Brokers is concerned. However, as far as the street is concerned, the holder of the shares is Interactive Brokers. It's one of the reasons why when you look up a lot of stocks, you're going to see all of the banks are going to be represented as big holders. If you see Goldman Sachs, Morgan Stanley, JP Morgan, and a host of brokers as big holders of the shares, does that mean that they have taken a proprietary interest in the shares? No. It likely means that they hold a lot of shares on behalf of their customer accounts. Now, why this matters is because those institutions that hold shares in street name actively engage in securities, borrowing, and lending. And so when someone goes to borrow shares, if you own them, the shares that you hold may have been lent, but nobody called you to ask you about it. It's just part of the natural securities lending process. Now, large institutional holders or people that, for example, for whatever reason, do not have their securities held in street name. For a long time, for example, I think my mother was an investor in Kimberly-Clark. She held shares in Kimberly-Clark for a number of years, and I think she probably still does. And those shares were actually in her name. And actually, there were a lot of instances where They had dividend reinvestment plans. People could buy stock essentially directly from the company, and then they could make it so that the dividends that they would receive would automatically buy more stock. And then their names were essentially the registered owner. Now, in that case, those securities are not necessarily available to borrow, right? So there's a little bit of nuance here that not all of the shares of the float would necessarily be available to borrow for reasons like this. You could have some are in street names, some aren't. There could be little nuanced things like that going on. But what you want to draw your eye to in this page right now, let's see if I do this, is this section up here inside that box. What are we looking at? So two of these are third-party scoring mechanisms to reflect whether or not a stock is at risk of a potential short squeeze. Coal stores, I already knew that it was at a high risk of a short squeeze. There's a high, so nearly half of the float is short. S&P Global has their own short interest score, and we can see that that's, on their scale, this is a relatively high number. The S3 scores go from 0 up to 99 or 100. I can't remember whether it goes exactly to 100 or it goes to 99. Suffice it to say that in the S3 squeeze score, if it's over 70, these are names that are at a high risk of a short squeeze. So that's going to factor in. Now, I will also say that on the institutional side, and this is not really applicable to me in my current seat, but when I was trading and making markets, I would get rundowns from our SEC lending department, our securities lending department, that would basically tell me everything that was GC, which is, just good collateral, it's general collateral. So you could borrow or lend it without any issue. Hard to borrow and impossible to borrow names would also be mentioned. Very often, the securities lending operation at my firm, in the hard or impossible to borrow names, would in turn actually ask me what the cost to do reversals or conversions in the underlying security would be. The idea being that if they thought they had an opportunity to either borrow the shares or lend the shares at something that differed materially from what the cost to reverse or convert would be, which is just swapping synthetic stock for common, then they might ask me to do that on behalf of the firm, and we could term loan the stock out or do things like this, right? So do I look at the short interest every time? No. Do I look at it in situations where I might be pricing out the options or the carry cost in a name that I haven't been looking at every day? Well, then yes. So a little bit of nuance there. If you had asked me a question about Alphabet, would I have gone to look at the short interest? No. Meta? No. Nvidia? No. Look at these stocks every day. You guys do too. But some of these other names, if you haven't looked at it, it probably makes good sense to do so. And if you ever happen to be looking at the price of options, and you're looking at the price of calls versus puts, and you say to yourself, man, versus where the stock is right now, those puts seem really expensive, and you can't really put your finger on why, this is a really important thing to do. So if you see that, you're looking at, and how do you do this? Let's imagine you have a stock that does not pay a dividend. Let's say we're just looking at coal stores or any stock. You take the strike price plus the call price minus the put price. That's your synthetic stock price. You compare that to the spot price for the common. And if there's a huge deviation for options that only expire in 30, 60, 90 days, again, no dividends or anything like that at play, and you find that the common trades at a significant premium to the synthetic, there's a good chance that there is a borrow condition, that the stock is hard or maybe impossible to borrow. Seen this in many cases. Sometimes you'll see this in situations where there's corporate actions as well. Those are all things that you're going to want to take a look at. But yeah, it's not a default for most stocks. But if you're thinking, should I look, should I not? Yeah, why not? I mean, how long does it take you to just double check that? Okay, So let's get rid of that and move on here. I got to do this. All right. Rock and roll football. MRVL jumped to the level we were talking about last week. What's the option strategy now? I do have shares as well, but should I get rid of the shares and go options only? So yes, let's take a quick peek here. Did notice that we got, I think it actually was selling off a little bit after the fact. Today we got that pop, and then I think it intraday, did it open close to the highs and then sell off a little bit today? Yeah, looks like that. Okay, so I don't remember which day we were talking about MRVL. Would that have been exactly a week ago? Maybe last open mic last Wednesday? Not quite sure. So the stock would have been trading around 73.5 at that time. 81 3/4, call it $82, round numbers today. I don't remember. Okay, I'm being told it was July. Oh yeah, so it was exactly a week ago we were talking about it. Look, I mean, first of all, for those of you who hold the shares and may have held them for some time, and again, as I always say, I'm not providing any tax advice, but if you hold shares and you're thinking about swapping into an options only position in a taxable account, your basis is going to matter, right? So if you happen to have bought the stock, back off the post-Liberation Day lows, and then the stock is up huge since then. It's up 60% off the post-Liberation Day lows. Maybe that has tax implications for you where you don't want to take a short-term capital gain. So that would be a reason to not necessarily do that. I think I mentioned this. I have friends, former colleagues who have positions in Netflix with a relatively low basis, a couple $100 a share. And they're reluctant to do anything because the stock has to get hit so hard for them to justify selling their shares that, they won't even buy puts because they're afraid if they have to exercise their puts or do anything else that it has some implications. So barring something like that, I don't think that there's any reason why you wouldn't necessarily contemplate using an option strategy instead. All right. So this is a relatively high volatility name, as we can see here. I'm just going to get rid of the historical. So we're only going to focus on this one, which is the options premia. Let's go out 2 months. All right. So this is a relatively high implied volatility name. And what that means is that if you own the shares and ignoring potential tax consequences, you think, well, I'd like to participate with potential further upside, but I don't want to give back some of this really sharp gain that I've seen. I still have, look, the stock was also significantly higher not that long ago. What are some of the things you could do? You could replace your stock with either just long call spreads or, call spread riskies, call spread risk reversals, so that you can preserve some upside, but if you have a downside pullback, you're not giving back all of the most recent gains that you had, and you indicated that you had some stock. So let's just take a quick peek at what something like that might look like. We'll use September, regular way. I think that's probably as good a way to make a play in this as any. So we can just add we'll call it a short put in here. That's supposed to be a short put. Maybe go down almost let's just say we're going to take a tasty-like approach, right? 67.5 is the 16 delta put. 105s are the upside call. These calls are in the money, so I probably wouldn't be using those. I might be more inclined to use an 82 or 85, something like that. And you end up with a structure that looks a little bit like this. This downside, if you go all the way to expiration, that's what's going to happen. In the intervening period, though, this is sort of what your instantaneous return is. A strategy like this, put differently, a strategy like this is not going to have quite the same delta as your long stock. So converting into a position like this is, I remember I used to have I had a boss many years ago who said, when in doubt, do half of whatever it was. It's just like, do half. This is kind of like taking a half step, a half measure. You're reducing your long exposure. You're saying, okay, I still want to be long the stock. I still want to have some upside, but worst case, I'll take getting put the stock at 67 and a half rather than take the risk from 81 and three quarters, $82 down to that level. And obviously that mitigates a considerable amount of the downside. Those wings are going to decay at a relatively accelerated rate, so that's certainly something you could contemplate if you like. And the technical trend is still positive. FinWest, hi Mike, good to be with you today. I'm happy the tsunami warning was not any worse. No impact to my area. So I know you travel a lot, FinWest. Sometimes you are in Asia, sometimes you are in Hawaii. I know that it was the North Shore and the West Shore in Hawaii that was supposed to be potentially affected by these tsunamis. I was wondering, so I live in, for those that don't know, I live in the Bay Area, and not far from the Bay. We had a tsunami not that long ago. It's a relatively modest one, but it broke some docks away not far from where I live. Wasn't going to affect where I am. And then we had another tsunami warning several weeks ago, and all the kids that are at a neighboring school all came up to my street because where I live is relatively high ground, probably good enough for most tsunamis. And our dog was kind of freaking out last night, so I wasn't sure whether animals were behaving any differently than they normally would, and that was causing her to get really interested. But we didn't seem to have any material impact around here. And I think there was only one area of California that was really considered to be at some risk. There's like some areas in Monterey and a couple other areas where inbound water can funnel and therefore get a little bit higher and come in at an accelerated rate. So, but wherever you are, I'm glad it was not bad where you are. It wasn't too terrible where we are. But an 8.8 earthquake, you guys can correct me if I'm wrong. I think that was the last number that I saw. It started off as an 8.0 estimate, then an 8.7. Then finally, the last estimate I saw for the magnitude of the earthquake was 8.8. That is a big earthquake. And that is a little bit unnerving. If there starts to be a lot of geological activity anywhere in the Ring of Fire, those of us that live on the West Coast, obviously, it's a reminder, right, that we should be giving that some thought. Okay, rock and roll football. Which one of these stocks, Amazon, Apple, Coinbase, looks like the best options trades for earnings tomorrow? Well, why don't we take a look at each of these in turn and see what we think. First of all, from a fundamental perspective, kind of like Amazon here, just seems like they're doing a lot of things right. Multiple is not that crazy, given their rate of growth. So we've got, let's see where they're trading right now. 26 times next year's earnings with an 11% adjusted EPS growth and 10% off the top line. That's what the street is expecting, and not even a bad multiple on the full year earnings. I would say, in a lot of good and critical areas. It's interesting to me. Some of you may have seen the rumors that Jeff Bezos has talked about acquiring CNBC even. Don't know if those are true or if there's going to be any follow through on that. That's very interesting. He already owns the Washington Post, so he has exposure to the media industry. That would also be interesting, not necessarily for Amazon, because I'm assuming this would not be an Amazon acquisition, but it's interesting nevertheless. But I like Amazon here. So implied moves going into earnings, options higher or lower price than usual. Looks like they're very reasonably priced going into earnings. The average absolute price move, so the mean absolute deviation over the entirety of this history, by the way, is going back to 2014. So this is 11 years, 44 reported quarters. I can go back further, but I'm not 100% sure it really makes much sense to do that. I tend to like to look at more recent results as a better barometer, especially in companies that 10 years ago, 15 years ago, in Amazon's case, if we go back to the tech bubble, that was a very different business then, right? So does how the stock behaved after earnings were released back then have much bearing on how it might behave now? And the answer to that, in my view, is no. And we can see that actually in recent quarters at least, I'm going to just highlight that here. So just the last 4 quarters, that's this section where that little box is. 4 quarters ago, down almost 9%, followed by an up 6%. But the last 2, not too big, not very big moves there. And is that gonna? Okay, happily it did not exit my thing here, so that's good. In terms of option sentiment going into this, well, volume actually is a little bit modest, a little bit light today, but it'll probably pick up tomorrow. So, we often talk about the options volume the day before a company reports, but it matters whether or not that company reports pre or post open, because oftentimes when they report after, after the close, the real flow might take place that same day, right before the numbers come out. But in general, call volume has significantly outpaced put volume for quite a while now. We can also just take a quick peek at sentiment, option sentiment, by just taking a look at something like skew. On the skew side, what we're going to do here is I'm going to see if I can take a specific expiration. We can do this one of 2 ways. Let's just do 1 month first of all, and compare that. Okay, so now I'm looking 1 month out. This is what the sentiment was a week ago in red. You can see the puts were a little bit higher, and the way upside calls were a little bit lower, but it's pretty much the same. And we have the present day in white. But the caution I would give you about taking this approach, where I'm looking 1 month out, is that that's a 30-day forecast. And what that means is that a week ago, I was looking at how things were going to be between, the 23rd of July and the 22nd of August. Now I'm looking at the 30th of July relative to the 29th of August. Instead, what happens if we take a look at a specific expiration and what the shape of options look like in that context? So now I'm looking specifically at August 15th expiration, okay? And we have that number here in white, and where it was a week ago in red. And this gives us a slightly different perspective, doesn't it? Because one of the things you can see here is that the downside has certainly gotten a bigger bid in the August 15th expiration options relative to the calls, relative to the exact same options expiration a week prior. So I like Amazon. Options seem very reasonably priced in terms of making directional bets. So if you wanted to buy call spreads, something like that, they certainly seem reasonably priced to me. Okay. What was the next one? Apple. Oh, yeah. So Apple, this one, a little bit of news in Apple today, because I believe that Mark Zuckerberg, his super AI team, whatever it is that he's building over there at Meta, managed to poach a couple more key AI executives from Apple. I think that was announced today, was it not? They had already grabbed, I think, one of them. And I know these contracts they're handing out are unbelievable. Let me see here. Just want to make sure I'm not misremembering this. Let's see. Why did I think I saw that? Did I see that yesterday? Maybe I saw it yesterday. In any case, I'm quite sure that the flow of AI expertise is going in Zuck's direction. I think we can safely say that. I will say I'm a little less enthusiastic about Apple. And why is that? So Apple's earnings growth has typically been quite good, as we can see here, lower left-hand side of your screen. The issue that we have, though, is that it significantly outpaces revenue growth. That's not always that unusual, but the revenue growth has been pretty static. for a long period of time, EPS growth has been good because of the accretive effects of stock buybacks. Nothing wrong with that as a way to return capital to shareholders. And as we look down here, that's this section down here that we're looking at, free cash flow. Certainly the company has free cash flow to spare for buybacks, so all of that makes good sense. But for me to really get excited, as I've previously said, to allocate to an individual company, I would like to see that company growing revenues, preferably faster than GDP. They are very slightly here, and maybe faster than the S&P more generally. Amazon kind of gets on the high side of that mark, but Apple falls just short of it. So I'm a little less enthusiastic about Apple for those reasons. Let's see what kind of multiple we got on this one. Let's just call it 210, 760. We've got, this one's actually trading about a turn and a half more expensive than Amazon is as well. So, it's a bad name to hold? No, I mean, it's still a phenomenal company. They still have a commanding market share in North America. This is less true in some other places where Android devices predominate, but still excellent market share here. So now let's just take a quick peek at what's going on in the options land. Ahead of this, similar story in terms of the options volumes. Just remember that on those situations where you get operating results coming out post-close, oftentimes the big upticks in volume are going to take place afterwards. Here, too, the implied move is pretty modest, but this one doesn't really move that much on earnings. In fact, the last quarterly earnings where it dropped 3.75% was the largest of the last 4 quarters. But again, reasonably priced options, implied move is less than 4%. So don't sell covered calls going into it. If you're long and would rather a stock substitute, buy some upside calls. I don't have a problem with that. So, but between the two, Amazon or Apple, I'm with Amazon. Let's move on. Coinbase. Let's have a peek at Coinbase. So, I mean, the crypto space is on fire as far as I'm concerned. It is, different areas are growing for different reasons. In terms of a reserve asset, I still favor Bitcoin over some of the other platforms. But as our good friend and colleague, Professor Mark Guttner, articulated, I believe it was on Office Hours last week, some of these others, like Ethereum, that in the payment processing space, they have important roles to play. We've seen a big move in that space, but, for what it's worth. So here, if we're taking a look at, how the business is doing and what the backdrop is, it's all good. So that is definitely a meaningful positive. If these free cash flow numbers begin to hold up, in other words, because you can see that we actually had better numbers in 2024, it kind of fell off. But if we get back to a consistent free cash flow growth, then on that basis alone, because the way it's forecast right now, it's looking at better than 3% free cash flow yield relative to enterprise value for full year 2026. And that's with a material year-on-year growth rate, right? So what are we looking at? 30 to 40. That's the number you're going to want to pay attention to. But 25% growth in free cash flow, that's a pretty good situation. So I would generally like that. We'll take a quick peek at what the options flows are doing. Here, same kind of story that we saw in the other two. Implied move. Are options expensive? Are they? Ooh, they're cheap. Look at this. So let's just take a look at. I keep saying that, and I don't know whether you guys are focusing your eye on the right number. What is it that I'm thinking about when I say, oh, they're cheap or they're expensive? Let's just take a look at the price of the straddle that expires this coming Friday, which is going to be the call and the put that are basically at the money. That's the 377.5s in this case. So the 377.5 calls, bang, dead on the money. mid-market price of $13.50, which is 3.6% of the current stock price. And when you take a look at the kinds of moves that the stock has seen over similar periods, if you bought calls at that price last time, it would have been an even push. Spent about 3.5%, have the upside, but the stock was down 3.5%. So either way, you'd have lost your 3.5%. Quarter before that, stock was down 8%. You'd have lost 3.5%. Period before that, you'd have lost 3.5%. Stock lost 15%, and so on. So what I'm saying is that, it doesn't really matter whether you have a bullish or a bearish thesis here. The point I'm making is that you're getting a very good sort of risk-adjusted bet, given the kinds of moves that the stock has experienced over the course of the last several quarters, right? So you'd have been better off buying options if you could get them at approximately the price they are right now than just going out and buying the stock based on what we know about how the stock behaves. So I'm actually kind of surprised by that. Maybe more examples of the overall complex, the crypto complex and everything else sort of becoming an increasingly mature business, and people's expectations that maybe volatility is going to start to come in as adoption increases, as the regulatory framework sort of has more definition and all of that. So, okay, Tucker D. Dog. Any tech business where they can twist dials on the fly, going back a long ways, doesn't make much sense. Any tech business where they can twist dials on the fly. Who's they? Twist dials. I'm wondering here. Oh yeah. So I guess, yeah. I mean, in the case, so Amazon was one of the. I think we were talking about Amazon at the time. So Amazon was one of those businesses. Netflix too. So there's a bunch of companies like this where companies that are pivoting from a growth phase to a more mature phase, or have gotten mature enough that they can just ratchet up their margins enough to sort of turn on the spigots of profitability. That's a circumstance where going way back and taking a look at how the companies were performing 10, 20 years ago, and they were in more of that growth phase and hadn't completely gotten market domination yet, comparing where they are now to where they were then doesn't make much sense. Yes, okay, I agree with that. And Tucker D. Dog follows up by saying, funny, he's poaching AI staff from Apple when Apple's AI strategy hasn't exactly been all that great. Yeah, that's a good point. Apple has taken a lot of heat for all of these AI promises that they've made, and then sort of backpedaled from a little bit. All true. But that doesn't necessarily mean that some of the technologists, engineers, AI experts that they have don't have a tremendous amount of value to add. So, Microsoft moving 3 times the expected move. How is... Oh, here we are. Sorry. Let me just... Yep. Microsoft moving 3 times the expected move. How is the, quote, market that far off? Schwab has a market maker move number that was below the expected move too. So does that mean market makers also off? So let's think about this for a second. Are the market makers off? Not necessarily. What do I mean by that? If customer flow sells a lot of options premium at levels that don't make much sense. Doesn't matter whether it's Microsoft. Let's just talk about generic stock ABC. So generic stock ABC typically moves 5% the day they report. And let's say we have a really consistent and long history. And there haven't been material changes to the nature of the business over time that would suggest that this quarter is going to be remarkably different than any prior one. Now you take a look at the price of the at-the-money straddle that expires at the end of the week, and let's just say it's 3% of the current stock price. So the average one-day move is 5%, and you have an option. You have a straddle that expires in 2 or 3 days, and that price is 3%. So comparing how the stock has historically behaved to what options prices currently imply, you're saying those options look cheap. You can see me doing this kind of analysis every time I look. Does that mean the market makers are wrong? Well, no, because market makers are really pricing options based on two things. One is what they know about how an underlying stock behaves. And in a vacuum, that's going to be the principal driver. So if nobody traded any options, nobody bought or sold a call or a put, and I just had to, you took stock ABC, it's never traded options before, and you're going to ask me to make a market on those options, I'm going to use the stock's historical behavior to make an assessment about what the value of those options should be. The historical volatility will very likely have a very close relationship to the implied volatility. That is the price that I set for the options. On the other hand, if I do that and people just sell covered calls, and so I lower the price a little bit and they just keep selling covered calls, and then people start selling cash covered puts, and the only thing that's coming my way is option selling, well, I may still think that the options price, the straddle, should be worth 5% of the current stock price, but I might continue to lower the bid that I'm willing to pay for options until flow balances out. That's kind of how market making works. Somebody sells you something, you buy it, you lower the price. They sell it to you again, you buy it, you lower the price. That's what market makers do. And they will continue to do that until people start to buy it from them. And then they'll start to raise the price again. So there are circumstances, and this is a really important observation for all of you to make, which is that there's a lot of valuable information that can be embedded in options prices and implied volatility, but they can be wrong. They can be materially wrong at times if all of the flow is just coming one way. And the market makers are not wrong because, remember, they're just buying this stuff. And when they're bringing the price down and down and down, they're just buying it cheaper and cheaper. So they're not going to tell anybody that, somebody comes in to sell them straddles, upside calls, downside puts, and they think these things are cheap. They're not, call the guy up and act like Helmsley did many years ago. I don't know if you guys know what I'm referring to, and say, I think you're selling this too cheaply. And by the way, if you're wondering what I'm talking about, Helmsley, he's no longer alive, but he was a big New York real estate billionaire. The Helmsley Palace, I think arguably one of his wives, his last wife, Leona Helmsley, was maybe more famous than he was. But they had the Helmsley Palace, they had the Helmsley Building, which is right by Grand Central Terminal, right underneath what was once the Pan Am Building, later MetLife. And famously, he owned, I think, millions of apartments. There's some crazy number of apartments and a lot of commercial buildings, but he had a deal to buy a building in New York. And the guy came to the closing, and he basically paid him considerably more than the asking price. And it was, and this is many, many years ago, but it was several $100,000 more than the guy was asking. And, the guy said this wasn't the price that I was asking for it. And Helmsley said, yeah, you were asking too little. Like, voluntarily paid him more money. It was kind of a famous story. Now, I don't know whether that was apocryphal or not. Was it actually true? Who knows? That could have been somebody who was burnishing Helmsley's image was telling that story. So I don't know if it was true or not. But what my point is that doesn't really happen in business. It doesn't really happen in trading. If you're selling something too cheaply, the buyer's going to be the last person on earth to tell you in most cases. And market makers don't, it's not even like a direct relationship. They're not saying, are you sure you feel good about selling it? They're just sitting there with machines on. So as long as people keep hitting bids, the price will go down many times algorithmically until flow comes the other way. So it's not really that the market makers are wrong so much. And that's where the opportunity for you all comes in, because if flow is very one-sided and improperly so, you're going to get opportunities like this. Like when I see some of these stocks and I'm saying, gee, a 5% implied move, Coinbase seems low. Does that mean it's going to move more than 5%? No, The average is higher than that. I'm just saying that, gun to my head, I can bet with the stock or I can bet with the options. When the average move is significantly larger than the options is implying, then unless I can identify some reason why it's going to be particularly quiet this time relative to other periods, then I'm going to use options to do it. And the options market makers aren't wrong per se. They're just responding to flow. So, lengthy, sort of winded answer, but I hope that's helpful. So, FinWest, my home is on the southeast side of Oahu and 50 feet from the water. 50 feet from the water. You are close. But a bit inland, so I have a natural buffer. You're right, 8.8 is potentially devastating. Good we both weren't affected. Yeah, it's interesting. The last tsunami we had here, and I knew there was one. It elevated, and it came in around the period of high tide. My wife and one of her friends, they were walking down and around by the water, and her friend said something like, "Oh, the tide's very high today." I said, "You think?" I mean, when docks start floating away, it was interesting. It's not dramatic. It's not like some big crashing wave comes in. It's just that the water just rises and rises. You don't actually see a wave. It's just that there's all of a sudden lots more water coming in with the tide, and you don't really see crests. It's just a wall of water, and all of a sudden the water's just higher and it's everywhere. In that case, it was only 2 feet. So, went over neighborhood walkways, ripped some people's docks apart. There's some apartments that are not that far from me, and I'm imagining if I was on the first floor and I go out on my balcony and my balcony's, 10 inches from the top of the water, it's probably a little nerve-wracking, but that was as bad as it got over here. Rock and roll football market's been up so much since the Liberation Day, and August's been weak historically. Better August open and post-election years, but still weak. Do you think the market dip is coming? And a percent. Do I think a market dip's coming? Yes. Do I know when and how much? No. If I knew that, I would be unique. I don't know that anybody knows exactly when it's coming or how big it's going to be. I think many people expect it, and the reason that they do is this. So let's just take a look here. Let's get rid of the price. And we'll do this. So this is really the reason. This is the thing that people get concerned about. Oops, what did I just do? So they just changed this function. You all have seen me use this many times. So GFGE function. And I'm one of those people that I'm a big user of the terminal, as you all will know. And let's do this. P ratio estimate. Okay, and I'm going to get rid of, let's get rid of revenue, we'll get rid of EPS, just maximize this. So this is the part that people are worried about. Okay, this is the multiple to forward earnings. And I can ask you, what do you guys think? What do you all think of this? I don't know if this will let me go. Let's see how far back this thing will let me go. Will it let me go back to 95? Probably not, but I'll try it. See. Okay, it does. All right. So why am I worried about a potential pullback? Well, this is where we are on a price to forward earnings basis right now. Okay, 22.7. This period right here probably doesn't deserve that much. You can't really think about this the same way because this is during the pandemic period. So earnings at a lot of businesses fell precipitously. So there's a big dislocation. And you can see that in this sharp downward and then upward move. So what happened is that immediately stocks plummeted, but forward earnings estimates didn't come in quite as much, right? So that's why it went suddenly down like this. Then all of a sudden people said, oh my God, they're shutting the economy down. How much money do businesses make when the economy's been shut down? And the answer is zero. So all of a sudden everybody's estimates came way in, And even if the stock prices didn't fall further, their multiple exploded. So that's what the sort of V-shaped rebound was. But this whole period represents an area of significant volatility, not just for stocks, but in analysts' estimates for how those companies were going to do in the immediate future. And these multiples, for what it's worth, is, only looking out a year or so, because that's the forward multiple. Now, so put this into perspective. So if we ignore all of this and we take a look at where we are relative to forward multiples right now, without something like that happening, where do we have to go to see multiples similar to this? Well, we have to go all the way back over here. Okay, so this was August of 2000. The peak of the tech bubble was March. That was right over here. So as you look at this, you can say, well, I'm optimistic about the economy, and I generally am. Things have turned out better than many had forecast they would, and they have. But this is the part that gets people anxious. You do not get into circumstances where you have really extended multiples for prolonged periods. But, the real question you need to ask yourself is, where are we in this process? Was this a magic number, by the way? Was 25 times forward earnings for the S&P a magic number at which the market would roll over? Well, the answer is no. That took place in April of 1999. So multiples can get extended, and eventually a reckoning follows. But as we can see, they were most extended on a theoretical fundamental basis in April of 99, but the market top didn't happen until 11 months later in March of 2000. So where do I think they could fall? Well, I think they could fall back to something more like a mean multiple. And a mean multiple is going to be something in the neighborhood of probably 17, 18 times. So that would represent a more than 20% decline from where we are. So formally a bear market. But remember that when this happens, makes a big difference, because if we see 10% year-on-year EPS growth and then have another similar forecast for the following year, and then the multiple falls, then you're going to fall, let's call it 20% off of that new higher number. So, I think we are vulnerable. I will say, though, that, it's really difficult to come up with the timing. I mean, don't forget that if we look at this chart, let me see if I can find it, right here, okay? See where my cursor is? This is when Alan Greenspan said that he thought that the equity markets exhibited irrational exuberance. Would it have been a good idea to go short the market in 1996? It would have been one of the worst things anybody could have done. And a lot of bad news, by the way, followed that irrational exuberance into the market peak. We had the Russian default. We had the collapse of the Asian tigers. We had the long-term capital management default. We had a lot of bad news in there. And equities continued to, they would get chopped up, and then they would rebound from that. So I wish I had an answer to this. I'd probably just be parked on a beach if I knew the answers to questions like that one. If anybody finds out, you let us know. We'll all retire, and it'll be great. But these are the things I'd like you guys just to think about it. Keep it in the back of your mind. Okay. Did you hear that the guy who called the 100-bagger on Carvana is now saying open should get to 82 in a couple of years? What would be a good way to play it long? Why was I just looking at this? Did we talk? I don't know. Did we talk about this on maybe somebody can get into my ear and tell me whether we discussed this recently. Maybe somebody was asking me about it on this thing. Somehow I kind of vaguely remember that. So let's talk about Carvana before we get to this one. The issue, so this is an interesting one because Carvana, if you guys did not know, obviously it's been on a huge tear. Remember one of the things I've often talked about, which is that the more levered a business is, the more volatility can potentially exhibit. Carvana was really an interesting case because this thing was really on the ropes at one point. Massive negative free cash flow. So let's see if we can get down. That's down here at the bottom. Quite a lot of debt. And an extraordinary valuation, frankly, for a business like this. You know who used to talk about it quite a lot on Fast Money? Karen Feinerman. And I talked about it a lot too, mostly out of sort of, I'm not going to call it morbid curiosity. It was not a name I was long at the time because it seemed very binary to me. And it was an extraordinarily difficult time. So in and around this period, let's talk about what was going on. So we ended up with a car shortage. Used car prices were going up significantly. This was a kind of a novel approach. They had those coin-operated vending machines for cars. A couple cities have them. I have personally done business with Carvana for what it's worth, not buying, but I've been a seller. And they took in a lot of inventory. And then, of course, some of the supply shortages started to reverse. And then, of course, in the midst of all of that, you have to start marking down the value of that inventory. So you're thinking that the balance sheet is starting to get a little bit upside down. There were plenty of concerns, and just all of this leverage and the negative free cash flow. They were running out of money in here. Let me see if I can. Oops. What happened? Okay, good. Didn't blow that up. Okay, so if we take a look over here, this was the period which was particularly interesting. Annualized free cash flow, so a 12-month negative free cash flow of $3.1 billion, and they had $400 million in the bank, which they were losing. They were basically losing the amount of cash that they had on the balance sheet about every 6 or 7 weeks. So they were really close. Now, the flip side of all of this, look what this market capitalization got down to. So the equity in the business was only a tenth of the enterprise's entire value. Now, I will tell you that now that we're up to these kinds of levels, it's still a little bit tough to really figure out how this makes tremendous amounts of sense. I mean, it's a car dealer, and that's a car dealer that's got a $73 billion, it's multiples of its revenues. That's pretty remarkable, right? So $5 a share, $330 a share. That's a high multiple. So, question: could Coin do this? Not Coin. Excuse me. So, could Open do the same thing? Maybe. This is another situation where you have a decent bit of leverage here. So, not as much. $1.5 billion market cap, and so the net debt is going to be the difference between the enterprise value. So that's when you take the debt, you subtract the cash, and you add that to the market capitalization to get the enterprise value. It's maybe a more accurate way to think about how a business is actually being valued. But here too, not as bad as the Carvana case, but what creates the sort of spring-loaded circumstance is when the cash flow is, really dragging the thing into the ground. Trailing 12 months, the company had negative free cash flow of $700 million, and they've got less than $700 million on the balance sheet. Now, this is a very different picture than Carvana in the sense that Carvana was going through about 6 weeks worth. It was going through their cash balance about every 6 weeks. Nothing like that here. And, perhaps more importantly, if we take a look, the forecast now is that this coming quarter, we're going to get a big positive free cash flow number. That totally changes the game, right? That's a game-changing number. $700 million versus, negative 283 in free cash flow the previous quarter, because we're looking at quarters now. That's going to make a big difference. Is this the kind of name that I'm going to pile into? No. It is not. Does not hit my criteria on several fronts. It does not on the revenue growth side. It does not on sort of consistent historical free cash flow growth. There's not positive earnings yet. And that does not mean that this doesn't present an opportunity for those who are willing to speculate. It may very well. Just not the kind of thing that I go in for. You certainly may. Now, here's the thing. Oops. Let's see if I can actually type properly. The stock itself is also basically an option at this point at, $2 a share, right? So if you're taking a look and saying, well, is there any strategy I could do other than speculate and buy the stock? There is. You think that it could be a 100-bagger in a couple of years? Maybe. But why don't we take a look at what that would actually cost if you're going to use options to do that instead? So we'll go out 2 years. We'll go to January 2027. And you take a look at stocks around $2. $2 calls are $1 or so. So they're 50% of the current stock price. Now, remember what we began this show with. We were talking about somebody, who was it that asked me? I think it was Jim. Yep. Jim was asking about short interest. Okay. Now, here's where things get a little bit funky. If the stock goes up, let's say the stock doubles to $4. But let's also say that the stock becomes hard to borrow, right? So it's short 22% of the float right now with an S3 squeeze score of 50. Now, if the stock doubles, but the short interest also doubles, so now you're looking at 45% of the float, we get into numbers like we had in coal stores, and the stock becomes hard or even worse, impossible to borrow, what is going to happen to the extrinsic value of those calls? It is going to go down. So right now you have $1 and change, or about $1 of extrinsic value, 50% of the current stock price. But it is possible that the stock could go to 4. Those things could become an early exercise because the stock was hard to borrow. And so they'll only be worth their intrinsic value at that point, which is 2. Now, I'm not saying that's going to happen, but think about that for a moment. What that means is that if you bought the stock at 2 and it went to 4, and the stock became harder or impossible to borrow, you doubled your money. And you bought the call options at $1, now they're worth 2, they're new intrinsic value, and you doubled your money. But if the stock simply goes sideways, and you just sat there for 2 years, what happened to your call options? They're worth 0, and the stock's worth $2. To me, that's not huge. That's not so at the money long dated calls, because you already have. So this is, I'm really glad, this is a really interesting set of questions that we got here that just by coincidence happened to align as things to think about. This is a situation where I could see this stock becoming hard to borrow. And I am thinking ahead to what happens to the value of long-dated calls if that does happen. If the stock becomes impossible to borrow, a lot of the extrinsic value of those calls is going to go down, and the extrinsic value of puts will rise, all else equal. And I'd have been maybe almost as good off buying the stock, and I wouldn't have had to commit a whole bunch more capital. So if I was going to speculate on this thing, I probably would just do it with the stock on that basis. So I don't know if that helps you at all. I hope it does. Like I said, this isn't really on my radar. I was running a 40 Act fund, by the way, so we didn't. This is a penny stock. It's less than $5. We didn't buy these kinds of companies anyway. But yeah, those are good things to think about. And we've chewed up more than an hour. That might be a good place to end. So the very first question Jim Howard was asking, do you look at short interest? But in a case like this, it makes good sense to do so, because it does play into your calculus about whether or not the stock is almost a better option on itself than options are on it. This is a situation where I could see the stock become harder to borrow. If there's a short squeeze, owners of calls, owners of stock are both going to benefit from the appreciation in the shares, but owners of calls will not if the stock becomes harder and impossible to borrow because of the borrow cost, and that'll suck out some of that extrinsic value in those call options. So I guess we will end it right there. And hopefully we're going to have office hours on Friday with Mark. I don't remember what he said. Remember, again, we're not going to have open mic next Monday. As I said, a bunch of people are going to be out of town, yours truly included. But for all of you guys who tuned in today, I really appreciate your time and attention. I hope some of the things I said were helpful to you. Thank you very much for watching.